we're looking at the dollar index daily chart on the left-hand side. We traded up into, but we have a old buy-side balance, sell-side efficiency, and we're stuck inside that right now. There's buy-side resting here, and then there is the consequent encroachment of the suspension block in here. We already traded there, so any movement back down in would be problematic in my opinion, because we've already done enough in here for the suspension block to yield its help in terms of supporting prices sending up into higher prices. So I don't want to see anything traded down below consequent encouragement. I don't even want to see it trade back to it at all. Now, can it touch the lower quadrant of that daily buy side and balance sell side efficiency that's shaded in pink here? Can it do that? Sure can. But I'd prefer it not do that like it's done so far. See how it's come down real low to it, but it hasn't done the actual touch. So that's good. Here's the business on the 5-minute chart dollar index. And we came down, cleared some sell side here, there, rallied up. We had a breaker that's normally a bearish structure when it's like this. And when we trade above it, it acts as an inversion breaker. We see that traded here. And they left relative equal highs up here. So this to me, you know, it's kind of tricky, to be honest with you, because we have these on the buy side, but we also have the sell side down here. So that's why I'm telling you, dollar index is kind of like it can go either way, and either side getting hit here or here could send it the other direction to get the opposite liquidity. I'll give you an example of what I mean by that. It could come down here, take this liquidity, and then come all the way back up and take that. Or it can come up here and grab that and then go down here. So it's kind of like a if then. If it does this, then I'll do that. If it does that, then I'll do this. So I'm surprised that dollar is where it's at right now, to be honest with you. With gold, surging above 4,000, plus, it's just against the grain for dollar to be performing like it's doing here. I would expect it to be in a smaller consolidation or trading lower, but it's not doing that, which is kind of like a decoupling. And it's not surprising because there's so many things going on. It is very difficult to just lean on the dollar index because the dollar index is not doing anything that you would expect it to do right now, given the climate, given the technicals of everything else that's going on in the marketplace. Those are the two pools of liquidity I'm looking for. So I'm kind of neutral on dollar. I want to see it stay firm, but if it goes lower, it goes lower to take this sell side. And that's the only interest I'd have. If it goes down below that and then really starts to fall out of bed, then I think that we'll probably see all-time highs resume in equities. So we're looking at euro dollar next. We have buy side balance, sell side efficiency. We're sitting inside of a pretty difficult, sloppy range in here. I think personally, because we've made it jagged on the upside here, a deeper retracement down into this buy side and balance, sell side efficiency is warranted. I think it would be helpful, but reverse the script for a second. Play devil's advocate in your own analysis. And this is what I like to do. If I'm wrong, how would I be wrong? And what would it be going for if I'm wrong? Well, we have relative equal highs and that are real smooth. And that's really sold the idea that that's strong retail resistance. And you can already see they're trying to muscle their way up in there. So we dug down into this buy side and balance, sell side efficiency on the daily charts already. And if we can muster the strength to get back above the immediate rebalance I showed here on the daily chart, it's trading at essentially the 116.49. So that's above these, obviously. So if it runs that and goes above and closes on a closing base on the daily chart above the immediate rebalance, then we're probably looking at some kind of internal shift that would potentially send dollar lower or stay in a very narrow consolidation, permitting the euro and cable and other FX pairs to move without its participation, as you would expect it to be the opposite. Whatever the currency like euro, cable, yen, whatever, they would go one direction and dollar would go the other. That's the normal dichotomy between them, but it's not always like that. Sometimes the dollar is held and then the other currencies are allowed to move around. And when it's like that, you will see the crosses like euro pound, euro yen, Aussie yen, all the non-dollar based currency pairs. They will do exceedingly well. They'll have a whole lot more movement, and they'll have freedom to allow the market to do whatever, wherever it wants to go, it'll go there quickly, and it'll do it dynamically, all the while the dollar index doesn't do anything at all, which sometimes is confusing for someone that's trying to trade forex. That's a condition that can happen in the marketplace. All right, so here is the cable market. You can see this discount. I'm sorry, it's a discount array, but it's a premium wick. So when price is up here and it's trading down, school of thought from ICT would be, while you're up here, it might want to trade down to this candlestick's open, which is to change in the state of delivery for the order block's furthest discount candle. This is the lowest one in the series of all these down close candles. So that would be a change in the state of delivery. It would be reasonable to expect that, but I'm not. If I'm looking for lower prices, I would look for that as like a speed bump, but I would want to see it then get into this wick. Okay, so that's the reason why I shared these levels in here. And also this one. This would be the one that you would use. But here is the premium wick. When price is up here and it's trading down, that's going to act as a inversion. So if it's premium on the candlestick, but price is above it, the algorithm will see that as a discount array. And we treat wicks like gaps. So in full theory, it would look like this, all levels for this. But in here, this premium wick is a level that the market will draw into when price is above it. So if market price is above this specific candlestick, and you're probably thinking, well, why am I using this one and not this one? You got to think in terms of when prices are high and the market price is above every PD array that you would have indicated on your chart. This is the lowest wick. So this would be the most in terms of a premium wick, every wick above the candlestick's body. This would be the candlestick that you would, or I would rather, anticipate reaching down into if there is no interest at all trading to the opening of this price. Here would be the change of state of delivery. So for order block PD array, that would be the level to draw to. But what happens if it doesn't want to go down there? Then you have to consider every one of these wicks, and since there's a series of them, you want to concern yourself with what's the lowest one it could trade to, and that's this one here. There's nothing wrong with grading this wick here, and if you do it, you'll see there's levels that it's tapping and using. But in terms of a deep retracement moving lower, my eye goes right here because that's going to be treated as a gap. You can see we traded down to the lowest quadrant, but not the low of that wick. But here's the open of that candlestick, and it's this price here, but the lower quadrant, not the high, not the upper quadrant, not the consequent encroachment, but the lower quadrant level at 1.32495, that level there is exactly what you see delivered to here. Price rallied above, and then we use the high of that wick right there. It hits it here, and then it rallies and it's starting to run back up. Looking at these highs here, we have potentially a high probability candidate for drawing liquidity because we have the lower high to the right than that one. So your buy side should be drawn on at around the 133.70 level or thereabouts. And then your sell side would obviously be the low here, and then into this candlestick's open, and then you would grade that wick down here if it starts to break down lower. But we've had several attempts now. We hit the high of it, this wick here. We hit that one. We went to the upper quadrant, failed to get to consequent encroachment, and then we went through consequent encroachment and went right to the lower quadrant of that one there. And this is a lot of give back. So if I were short, I'd be concerned because we've already done enough reaching down here. So where it's at now, it's concerned for short-term bearish. Gold, I said I would talk about that. You see we had a buy side imbalance, sell side efficiency is shaded in blue. Notice that it had no interest at all getting down to the upper quadrant. It used the top end of that, which is this candlestick's low. It hit once here, twice, and then said, I got to go. That is what you want to see. When you're in a bullish market, when you're looking for bullishness, you do not want to see my fair value gaps traded down into. You don't want to see them go to their quadrants. You certainly don't want to see them go to consequent encroachment. You don't want to see them completely close in. You have to have inefficiencies left open to indicate what? Strength. And if you're bullish, you want to see inefficiencies not be offered as a fulfillment lower. Because if the premium is real and it's an instrument that is technically undervalued, why would they offer the discount price? They wouldn't. Now, when we're looking at inefficiencies like this, we want to see price literally stay open. Because if the inefficiencies can stay open or fail to even touch the quadrant levels and it starts to rally, man, if you're long, that's when you want to start adding to your longs. You want to build in larger positions. That means every time you have a short-term retracement, anything intraday, you want to build that position up because it's already indicating strength. Leaving inefficiencies open like this is exactly what you want to see if you're bullish. And when prices is going lower, if it's leaving inefficiencies open and doesn't come back up into them, if it can't even touch the lower quadrant when you're bearish, that's really bearish. Well, in the same sense here, just reversing it, when it's bullish like this, we don't even want to see it trade down in the upper quadrant. And it doesn't do that. You need to have rule-based ideas and things that lean on that you can trust. And one of the things that I found the most trust in is when my fair value gaps form in price action. If they can't draw price down into them and I'm bullish, I'm wildly bullish then. And every indication post fair value gap not being traded into like it does here, everything past that on an intraday that's a discount array should be considered as a reason to go higher. And you can see the price action here. It's just a straight run up. They're not letting this thing go down. And they've already indicated down here that it shouldn't because it's kept at bay. It won't go to a discount. When this inefficiency right here, this candlestick's low, this candlestick's high, in between those 2 points, this candle's high, that candlestick's low, this portion of price action should have carried the market down to at least half and then rally. That's a normal bullish market. Can it come all the way down, fill that in, and go up? Yes, it can do that. But when it does that, I'm far less bullish on the marketplace. I would want something after it closes the fair value gap in. I would want something over here, create a new shift in market structure on a smaller time frame, and then look for the same event where it doesn't fill in a fair value gap. And then I would resume going in looking for longs. I don't like to trade a full closure of a fair value gap. I like to do that when I'm short. And if it trades down here, that's where I'm trying to take profits. But I do not like to buy a full closure of a fair value gap when it's a buy side and balance, sell side efficiency, and I'm bullish. I don't ever want to go in there and do that. Look at my trades. Do you ever see me executing like that? It's never happening, folks. You learn more from studying my executions. I mean, look at where I'm entering. I'm entering at the best places at the best time, and I'm looking at areas where they don't fully close in, or I'm entering just after that's occurred. That's like the biggest tip and hint I could give you as a smart money operator. Nobody talks about that. They all want to see these closures. That's not what I've never taught that. I don't want to take those trades. If it's going to do that, then I want to see it. Give me some more proof. Then it needs to climb to the upper half of that inefficiency. Then give me some kind of a smaller 1 minute, 5 minute time frame shift in market structure where it gives another fractal form of this bigger buy side and balance, sell side efficiency, just done on a smaller time frame. And then if it can fail to fill in that one, then I'll start going in there and following order flow that way. But you just can't go in here and just simply say, well, there's an inefficiency and I'm going to get real bullish once it goes there and I'm going to buy that. Because think about it. If it's going to go higher, you want to be in a bullish market that's going to take off and just run. If you ain't seeing signatures like this in price action, you don't have an A+ situation where you're buying strength, really. You don't know if this is going to come down to that low of that fair value gap and bounce. When it does that, I'm admitting to you, when it closes the fair value gap in, I don't know if it's going to stop there and go higher, which is exactly why I gave the rules that I give you. I want to see it not fill it. If I'm in a long and I have a stop loss that's maybe at consequent encouragement or tick below it, and it starts trading below the upper quadrant, I'll kill that trade. Then I'll wait for it to come down and do whatever business it's going to do. And I'll take that loss. It's literally just like paying an insurance premium that I'm not going to sit in a larger loss, but I'm protecting myself and I'm guarding my mental capital. And then I'll wait for what I would rather see is that to show me a willingness to come out of that. If it goes in the lower half, it needs to come back out of that and then give me some supporting structure in a lower time frame where it does the same thing here, a buy side and balance, sell side efficiency that does not fill in on a lower time frame. Then I'll hop back on and start building my position up. With half the position I took as an initial loss in here, absorbing that, maybe I got a bad read on it. Maybe I was a little too overzealous. But I don't ever want to be buying full closure of a fair value gap. I don't want that. I want to see them stay open. You want to use this same concept anytime you're bullish on any market. If there's an inefficiency that's visual in the price action, you want to see what's being shown here. An inability for price to get down here. You want it to say, nah, man, you don't get VIP seating today. I'm going higher. But you, in your limited understanding, when you come to me, you'll see that as I missed a trade, it didn't give me what I wanted because I wanted to buy consequent encroachment or upper quadrant, and it starts to run away. If it's showing it on a daily chart, All you have to do is drop down to an hourly chart or anything less than and look for anything that's bullish at the right time of day. Those factors, when they come together, it's just like the puzzle pieces fall exactly how they should be. They dovetail nicely, and then you're on board. Gold's doing nothing different. It still does the same things, but here's the caveat to this. Gold is so manipulated. It's so suppressed. They do not let this market go to its real valuation. If it really was allowed to be at its real valuation, it would put Bitcoin on welfare because it's the world's currency. It's the world's money, gold. When it's down here, what was the premium array that it would reach to if it's going to go higher? This high right here. Since this is the highest wick compared to that one, this premium array, when price is down here, if it's going to draw up to this high, before it takes that high, we want to know what levels this wick offers in terms of grading it. And these levels are being shown here. Now watch, I'm going to give you a tip, okay? So these levels carrying over to the right, when price trades up to them, if when we trade up to premium rates, down here, that's this right here. All these moves from these lows here is this just shown on a 5-minute chart. That's this right here. So if it's going to go higher, we've been bullish for a while. At least we would try to see it trade up into this high. That would be the draw on liquidity, the 4,081 level. If that's the case and it's a wick, we grade that. How can we know that a move like this is going to come where it just keeps surging higher? Well, what you want to do is you want to go and buy this retail book, John Murphy's Technical Analysis of the Financial Markets. And everything in that book, you want to look at it and say, this is 90% likely it's going to fail. And then look for instances where they see price where it went up here like this and then turned and went lower. They're going to see that as resistance. What you want to do using my gradient levels, that's this area right in here. If the market's bullish and we're going to say this area here, the market moves off that inefficiency on the daily chart. Then it comes back down in the order block here and then rallies. It starts moving higher until we get up into that daily wick in this vicinity right here. That's this premium wick. So in this portion of price action, on this day, if we look at that like this, you want to your eye needs to be inside this little area right here. As soon as we enter that, you want to study how is price reacting when it gets to every quadrant and consequent encroachment level. Here's the tip, okay? If it can trade through the quadrant levels and it doesn't stop, like see how this right here went right to it and stopped and went lower? If you see that at anything like the consequent encroachment or the lower quadrant, and there's no bodies in the upper half or above the consequent encroachment level, then this is probably going to come back down and maybe come back into this inefficiency. Now, here's the $1,000,000 concept, okay? The quadrant here, while we're bullish, the body was laid over top of it. And then we had this deep retracement. The only thing it went down to is this suspension block. It comes down to it here and then rallies up. The bodies stop below the upper quadrant, but reference that wick. It's above this candle's high and it pierced. It's colored above the upper quadrant. So anything like this is consolidation in here because it's indicating the quadrants are being colored above. It's exploring above it. Discovery is permitted above the quadrants and they're not stopping price. They're coloring above them and then coming back in. They're going above them and then coming back in. But if you look real close, the quadrants are supporting it as a discount. Below, look at the open on that candle there. They wick just a little bit above it here. All of this consolidation around it. Look at the bodies coalescing around that. Consequent encroachment. We stop it here, trade back down in, and then boom, they let the cork out of the bottle. Bang, it's gone. And if it's doing that in a market that's really bullish after creating something like this where we have a big buy side and balance, sell side efficiency that doesn't even trade to its upper quadrant, man, you have a javelin. Like this thing is leaving. It's got someplace to go and it ain't going to wait around for you. And that's when you see it release here. And this is one of those instances where it leaves the area of focus, which is this premium wick. But when it trades above it, this premium wick acts as what? Is now a discount array. So the bodies are laying right on top of the high of it. And then they just start just letting it go higher. You can make your entire career just with this. Swing low. Market drops down, clears the sell side, and then leaves. What's this up here? What's this high versus this one? High probability candidate for a run on liquidity. If we have relative equal highs like this, and watch the bodies. Did we really do the business of laying a body over top of that high? This was just a small little shallow run. That means anything that was up here slightly above this wick is unfinished business. Unfinished business is a run on liquidity that was not completed. It's just a partial, just a tiny little drop down and then leave. No, they want that money. So everyone that's short here that had a stop loss, but if you have a buy side liquidity pool that's framed properly, as I give you, this is the right high needs to be lower than the high to the left of it. And when it's a buy side liquidity pool, but a low and a higher low to the right of it, it's a high probability candidate for sell side liquidity pool being purged. But if the market's bullish, you don't look at that like that. But if the market's bullish and it's left this, you want to see bodies plunge its way up into that. But look what it only did the wick, and then it drops down. The market did not leave a body out there, so it's dropping down, and the only thing it's doing is dropping down into a discount array, order block, rallies up, clears it, and leaves the body right there. That's officially running the liquidity here. This run from here to here, that's all your model needs to be, and you don't need a job. If you know how to frame this setup, which is something I taught in high probability short-term trading and scalping, these setups appear every single day, and it occurs every single New York open kill zone. It may not be a long, it may be a short, but it's always there. You need to know where the draw on liquidity is. If you're bullish because you have something like this, seeing a situation like this is a loaded deal, easy. It's a no-brainer. And looking for this type of framework here, this is an easy bread and butter model that everybody can do. So the bottom line is this: you have to subscribe to whatever starting point you want to reach for that's realistic. If it's silver bullet, that model, which is very simple, it's time-based, you're only looking at 1 hour of time. You're waiting for 10 o'clock in the morning Eastern time, and you're waiting for this type of scenario here. The idea of simply waiting for one setup, one little framework of price action within a defined range of time. Very, very specific element of price action that is limited to just one specific thing. See how even the candlesticks on the 1 minute chart didn't lay over top the high? So this is that buy side and bounce sell side efficiency on the 1 minute chart. So unfinished business in your notes, anytime a liquidity pool, when it's bullish, if buy side's been taken but no body's been left above it, it's unfinished. Expect it to come back for it again. That right there, and what I taught you about when to anticipate the run through when it's aggressive and so we just explode up using the quadrants, that right there is worth more than I charge for mentorship. This is the pattern. This is an all day, every day. It's going to be there 365 days. If the market was open that many times, you'd see it every day. If you are a gold trader and you don't put this information on your chart, you're trading blind, and it's information that you need to have. There's several opening prices that I think you should have. Is every midnight Eastern time, 9:30 in the morning, 6 o'clock reopen time, 5 o'clock p.m., and 4:14 p.m. Eastern time. That's enough for right now. That alone will start giving you X-ray view of price moves that you've never seen before. They're there. And the model I just outlined here, that little simple crackerjack of a model where it's just simple, unfinished business, it repeats every single day off of one of those opening prices too. Here's the equities opening price here, and it trades down to that, and you get that run here. But then we see it trade down into the macro of 2:50 p.m., 3:10. Now, this candlestick comes in at 3:08, but this is gold, and it's the last trading hour of equities, right? Gold's going to behave just like this when it's animated. Now, normally, when there hasn't been so much fever around gold, you wouldn't see big runs like this, but you would get some kind of a little setup that can be traded on a 15-second, 30-second, 1 minute chart, 5 minute chart, that type of deal. But don't expect like big, huge payouts. But because it's so animated right now, because it's so energetic, you're going to get these really nice responses like that. What do you think that is right there? High probability candidate for a run on liquidity. Here's an inefficiency. We trade down into it. Couldn't get to consequent encouragement or halfway point. Here's the halfway. Here's quadrant upper. Did it touch it? Nope. And it's rallying. This easy draw hits it right there. Keep your eye on this down here, okay? Boom. There's that larger 5 minute. Same pattern. Flat top right here. Easy sucker play. Comes right back down to that level right there. And it gets up to this level here, and then it comes all the way back down to some random 9:30 opening regular trading hours price. And then what does it do there? It sweeps it. It clears out the liquidity below here, and then rallies up. Old fair value gap. Picks it up here. What level? 4,116.5. Oh my goodness. What is the price low on that? To the tick. NASDAQ daily chart last Friday, controlled demolition. In the fall, stocks generally make a low and then they go higher into some measure of usually the last week of January, maybe the first or second week of February. And then it creates some kind of short term, intermediate term high. And then starts either if it's a bearish at that point, then it starts working towards the April, May highs. And then this works its way down through the summer into the fall lows. But we're in a market that is being propped up. It's primarily bullish. It can't trade down to a fall low like we would expect in a normal non parabolic bull market. Wouldn't it be suspicious to see how on one day they did a controlled demolition, and then now we went up here yesterday, and now we're right here. And they used this old discount wick low, perfectly delivered there. Look at this candlestick's right here, the September 25th. What's that candlestick low? 24,422.50. This morning, this candlestick right here, it's low, 24,421 even. So it hits it, trades minimum one tick below it for spread aspect. But look at the reaction there off of that. And then we have this inefficiency, which this is the inefficiency. It trades down into it here. When we have a wick like this candlestick here and this right there, whenever it's a old inefficiency, I look at this as immediate rebalance the same way. It's immediately rebalancing because it's going right back to the top of the inefficiency, which is this candlestick's opening price here. It need not trade down to that. It's doing the same function as a candlestick to candlestick touch. Like in other words, if this candlestick's high touched this candlestick's low, that's immediate rebalance. This is the same element of immediate rebalance because it's using the inefficiencies high as the immediate rebalance. It's going right down to it doing like that. And even though there's a small little gap, if you're bullish and you wanted to see it go higher, would you really want to see that completely close in based on what I've been teaching? No, you wouldn't, because it's indicating that it doesn't even want to give that discount there either. And that's exactly what I call it a signature for. Smart money sees that, and it's like a flag to them. What's this? Relative equal highs. Right high is lower than the left. This is a strong candidate for price wanting to run through. Same thing here. High, lower high. But I want you to see how it uses this old discount wick. When price was up here, it opened and traded down through previous day's low and into the new week opening gap, which is this candlestick's close and this candlestick's open. The candlesticks bodies are respecting the high of that 5-minute inefficiency that you can't see on the 1-minute chart. See how it's all muddied up? It rallies up. And then now look what it's using here, 24,582.25, upper quadrant of this discount wick. Okay, so the 25th of September, we're trading up to and above that upper quadrant. We trade to the low of that wick on the 25th of September, right there. Nails the low of the day. But it hits that low and stops. And then it rallies up. And it does something strange. It climbs above the lower quadrant of that discount wick right there at 24,475 and 3/4. These quadrant levels, whether they're on an inefficiency, like a fair value gap, an actual gap in price where there's no trading at all, or it's a wick, which we treat the same way. Every high probability fair value gap lays on top of a quadrant that I've been teaching you since I started back here again. What do you see at 24,475 and 3/4? What do you see? We went down to the low of that wick, and then it starts to go higher and pulls back to this quadrant. Well, if we rode this down, then I can use an imbalance on the pathway down. That means this is one right here. But is it on top that quadrant level? Look, what do you got here? We got this one right here. You see that? Where's the consequent encroachment of that fair value gap? At the perfect level on that quadrant. Is that one thing telling you? Nope, it's not. It's telling you that right here is that sweet spot. And you can accumulate along right there. And you need not concern yourself with this bullish breaker. If it's bullish, would it want to wait around to come back for a bullish breaker? If this is a V bottom? Nope. Rips right through it and leaves this. This is what you want to see when it's bullish. And here's 930 right there. Keep going forward. What do you see right there? What is that? First presented fair value gap. Happens. It just fucking happens to lay right on top of the upper quadrant of that discount wick. Here's the low, and here is with consequent encroachment. And don't see it that way. Here's your fair value gap laying right on top of the halfway point or consequent encroachment of the first presented fair value gap. On X, I said 24,660 relative equal highs, too smooth. And I said, watch new week opening gap in here. That's right here on this candlestick, because the market goes up and trades right back down to that new week opening gap high. It leaves, takes off. And then we get first presented fair value gap, it becomes an inversion fair value gap because it's SIBI here. You don't need to be down here. You don't need to be here. You don't need to be here. You can be right there and do very, very well. But as you can see, the market comes all the way back up to consequent encroachment of this wick, 24,738 and a quarter right here, 743 and three quarters. It trades there and keeps diving deeper into all of this inversion fair value gap. Now, think if we're in the fall and seasonally stocks make a low in the fall, what would it look like if we're in a primary bullish market and the fall low formed in a bullish market? Couldn't it have done it in one fell swoop like this and cleared any trailed stop losses below these lows, below this low, below this low, below that low, and changed where it went back into the last change of state of delivery here with this down closed candle. And then we opened up here and rallied up. And then we had one more attempt to make it look like it was going to go lower again today. And it stopped dead in its tracks on a level that I teach you, discount daily wick low. And then everything has been straight up since then. Look how it's just maneuvering around the consequent encroachment of that inversion fair value gap on the daily chart. Isn't that neat? This is time distortion. It's like a holding pattern. You want to be trading not in these periods. You want to wait until it moves again. It's not breakout. You want to wait for it to start running. When the market goes into another stage of protraction, then you'll see PD arrays form again. And if it's suggesting it's going to continue higher, or if it's retracing deeper lower, the PD arrays that form after leaving time distortion. You don't ever want to try to trade in these consolidations because you're not going to be apt to be correct in a limited understanding that most of you have right now.